Great. Well, I think we've got a great group of attendees so far. So I want to just first of all thank everyone for joining us today to talk about this very relevant and timely topic in the crypto markets. So the topic of our discussion today: bull run or bull trap, opportunities and risks as crypto rushes into the new year. And obviously, crypto is off to one of its strongest starts on record. So Bitcoin had the best January it's had in about 10 years or so, returning 40%. And the NASDAQ crypto index also had very significant returns, about 38% or so, which is its best, third best performing month on record. So strong start to the year, and we're always cautious to read too much into these things, but certainly I think with such a strong start from a performance perspective, it makes sense to talk about whether or not the bottom is in crypto, and we are at the start of a bull market or not, and so really. Ultimately, our goal today is to make sense of some of the recent developments, not just what's happened in January, but going back to 2022 and how some of those things will impact crypto in 2023. And really, the ultimate goal here is to separate the signal from the noise. And so I think I have two great signal seekers, you might call them, here with me today. And so Samir Kerbage is here at Hashdex, our Chief Product and Technology Officer. And for those on the call that aren't familiar with Hashdex, we are a global crypto asset manager. We have offerings across Latin America, Europe, and the US. And ultimately, our goal is to give investors secure, safe access to the crypto ecosystem through regulated investment products. Our other speaker is David Lawant, who is head of research at FalconX. And FalconX is a firm focused on building the infrastructure for the future of digital assets by enabling seamless price discovery, trade execution, and the transfer of value in order to really bring the digital assets to a broader mainstream institutional audience. And I'll let David talk more later on about his firm. But before we get started, I do, of course, as always, have to read a disclaimer. So bear with me here for a minute or so. This webcast is for informational purposes only, and nothing should be considered the official opinion of Hashdex or FalconX. This presentation is not an offer to buy or sell, nor is it a solicitation of an offer to buy or sell. Certain information contained herein constitutes forward-looking statements. Due to various risks and uncertainties, actual events or results and the performance of the products may be substantially different from those reflected or contemplated in such forward-looking statements. For any product-specific information, please refer to the appropriate prospectus. Great, and so let's go ahead and get started with that. And I should mention before we get too far along that please, if people have questions, to feel free to submit them at any point throughout this webinar. We'll try to save 15 to 20 minutes at the end to have a good Q&A session. But I want to start with Samir, and my first question is kind of a big and broad one, but essentially, what happened in January? How why the significant outperformance? And is this a sign of things to come for the new year?
Gerry, David, it's a pleasure to be here with you guys. So yeah, we got a very optimistic start of year, I would say, with crypto assets. And I think there are mainly two reasons. Like, first is the macro environment we're in. So it was a positive month for risk assets, including like US stocks. So crypto as a risk asset, as a risk asset class, is also being subject to the macro dominance we're seeing. So signs of the economic recovery in the US, of like either like a recession or a soft landing, those are factors that are affecting investors' decision around allocation to crypto and allocation to risk assets as a whole. And when we analyze like crypto specific factors, I think we've been since November, since the whole FTX downfall, believing through I would say a confident crisis in crypto, and especially in the market infrastructure around crypto, like players that went into troubles after those alleged frauds involving FTX. And I would say the fear of a contagion or another, I would say, liquidation waterfall that would pressure crypto prices down has been diminished over the last few weeks, right? As we see like Genesis filing for bankruptcy and, you know, like things moving to a resolution without a big contagion effect. So there's still some risks in the horizon, right? So we may have some risk coming from another crypto players as a whole. But I would say like the system is mainly deleveraged, and the marginal seller of crypto seems to be out. So actually, like January was a month without bad news, and after the few months we had bad news, no bad news is good news, right, for crypto. And we're setting we can speak a little further about this, but we're probably starting a recovery phase in crypto assets, or probably like the worst is over. Let's hope for that.
Yeah, we'll definitely get a little bit more into the potential for recovery momentarily, but I did, David, want to. Your firm is obviously like right at the heart of institutional activity and interest in this space, and you know, so I did want to give you the opportunity, one, just to kind of talk a little bit about the FalconX and your mission, but also kind of what you've been seeing last year going into this year, how things have changed, kind of, or if things have changed because of the performance in January.
Awesome. Hey, Gerry. Hey, Samir. It's great to be here. So let me start talking a little bit about FalconX, and then I can address your question. I joined FalconX actually pretty recently, and I'm starting the research function. FalconX is a leading crypto prime broker. This is a concept that most in traditional finance are probably familiar with, and that we basically transported to the crypto space. So the types of services that a prime broker does is, for example, trade execution. FalconX is connected to, by and large, the liquidity in the space, whether from exchanges or market makers or OTC desks or miners. So we cater to institutional investors, and whenever an institutional investor comes to us, we have access to all this liquidity. We add a layer of machine learning, and we're able to provide good trade execution for institutional clients. Our focus is on the institutional space. We have a broad range of clients that go all the way from the most crypto native hedge funds and VCs, all the way through traditional finance firms that are starting to play with crypto. We also provide other services such as credit, treasury management, custody, market making, and very soon research. So that's basically what we do. And I do think that being in a prime broker position is something that gives us a view on what a lot of the institutional market is thinking. In terms of the reasons for the rally, I think Samir nailed it. It was a combination of the perception of contagion risks relatively tamed, but also a much better macroeconomic environment. At least for the short term, right? So the market is now pricing in that inflation will recede. It will actually recede pretty quickly, as priced by the market, to something around 2% about a year from now. The market was also started to price in mid-December a reduction in the pace of interest rate increases by the Federal Reserve, which has materialized in the last meeting in January. Now the discussion is on whether we're going to see a pause, maybe in the next meeting, maybe in the other, but I think we're toggling between relatively small ranges here, or much smaller ranges than we were a couple of months ago. And then finally, the market is not pricing any big recession risk, at least as mainstream risk, because these things are being priced in as more on the tail end. I think the broad expectation of the market is that either there's going to be no recession or a mild recession. You can see that a little bit in credit risk spreads and companies' equities performance. So this bodes well for risk assets, and crypto has been a major beneficiary, to the point that if you look into the price performance right before the FTX event happened, which is, I think, November 6th, when the CoinDesk article dropped, leaking the Alameda balance sheet. If you look into the Bitcoin's performance from the day, or crypto's performance from the day before that until yesterday, Bitcoin's actually outperforming most of the other broad risk asset classes. I think maybe the only exception here is emerging market equities, but Bitcoin has outperformed the S&P 500, the Qs, and a lot of the other risk assets. ETH is a little bit more flattish, but this is somewhat surprising, right? I think if you told me on November 5th, a day before the CoinDesk article dropped, that we would see one of the leading exchanges in the world proving to be a fraud and failing in a matter of days, and also that carrying another important player in the space, I would not bet that Bitcoin would outperform other risk assets within two to 3 months. So it was definitely surprising. I think that going on from here on, I think the macro environment will dictate a lot of the price action in the space. This is definitely something that we are paying very close attention to. Today, the market is pricing this Goldilocks type of soft landing, perfect soft landing by the Federal Reserve. I think that the risks are, if those things don't materialize, these perceptions don't materialize, we might see a little bit of weakening from a price action standpoint in the short term. In the long run, and I think this is very important to highlight, the crypto investment case remains intact. I think that it's very clear that the FTX issue was a self-contained problem, a fraud issue in the crypto space, and that this is not an indictment on crypto as a whole. I always like to say that the solution for things like FTX not happening anymore is probably more crypto and not less crypto. Having that said, and just to finish my point here, the FTX issue had and probably will have a number of repercussions. And it was an important milestone for the industry in order to raise awareness to issues related to regulation, a few issues related to market structure, that I think that crypto investors, but institutional investors in particularly, will start paying a lot more attention to.
Yeah, and just would like to highlight one point that David raised, that the problems we saw with FTX and overall, most of the problems we saw in crypto last year, they were related to market structure, not to the asset class itself. This is a very important point, because if you are an outsider to this industry, you may mix those two concepts. And actually, like last year was a great year for the fundamentals of crypto, for the actual development of the technology. So the market structure in crypto is certainly flawed, and mainly because of lack of regulation. That we think that especially FTX would accelerate a regulation around crypto assets worldwide. So we've seen this happening in Latin America. We see this happening in Europe. There's discussions happening in the US that have been accelerated by the FTX downfall. So the need for regulation, for a more solid market structure in crypto, has shown its importance. And I think this can be like even a catalyzer for more adoption. After you have more regulatory clarity, you can have like more adoption and more people using crypto.
That's actually a very good segue for what I was thinking for the next question, and it really is around adoption. People are obviously always trying to figure out where we are in the adoption of crypto assets, and oftentimes there's parallels made to the internet. And Samir, you and I were talking last week, your perspective about the kind of link between where we are now in the crypto markets and the sort of early 2000s broadband phase of the internet. And it's an analogy I I really like, in part, I think, because I'm old enough to remember the old dial-up. That was how we all used to have to access the internet. But can you talk a little bit more about that comparison between kind of what was going on with the broadband adoption and kind of where we are in the with regards to the crypto market?
Sure. So one of the most frequent questions we get from institutional investors globally, right, in Europe, in Latin America, and in the US, is around the actual usage of crypto, right? So we can describe the investment thesis, we can describe like potential for crypto, and then they ask, okay, but no one is using crypto now. And what's the use case for crypto? What's the usefulness of crypto? It's very hard to see the usefulness of crypto because like any other technology evolution we saw in the digital transformation process our society has been in. So it started back with personal computers in the 80s, and then the internet in the 90s, and now we're seeing AI and blockchain and crypto as a next wave. It's very hard to see the implications of that like beforehand. And one of the analogies I like to bring is exactly the evolution of the internet, because I remember back then in the 90s when we would describe the potentials of the internet, so what we could do with the internet in the future, and people will ask, okay, but there's no use for, I can't use the internet now. Like you're talking about live streaming, a webcast for hundreds of people globally. But if I want to listen to a music, I need to spend like 12 hours downloading an MP3. And by the way, that's piracy, right? I can't do that because it's not legal. So there was a type of questions we got back then in the 90s, and that's the same type of question we're getting now around crypto. We're talking about a lot of promises of crypto, both from Bitcoin as a store of value, Ethereum as a major platform for the Web 3.0, NFTs, decentralized finance, tokenization, but like when you try to actually use it, it's very hard. It's complicated. The usability it's awful. There's a lot of risky things that you don't understand, and then like you're uncertain to interact with. And also, if you get like few thousands of people using at the same time, the transaction fees would skyrocket, right? And that's very similar to what we saw in the late 90s in the internet. So when you use dial-up connections, very slow, expensive, would take years or months to download a video, to do it it was impossible to do a live conference back then. And then two things happened that made the internet being the mainstream essential utility that we have now. So two things had to happen. First is the infrastructure. So infrastructure had to evolve. And the second is the generational shift, right? So the infrastructure evolution of the internet happened in the early 2000s with what we call the broadband phase of the internet, when we stopped using dial-up connections and start using broadband connections. And also the generational shift of the internet that allowed the internet to be this mainstream facility for us happened also over decades, right? When the new workforce came to the market, when the kids that grew up used to interacting with the internet, doing their homeworks using Google, using Yahoo, they went to the market, right? And then they started using internet in their day-to-day. That generational shift is very important because it doesn't come from the older generation, right? The older generation wasn't the one responsible for the internet adoption, for the internet adoption. And as I would say, older generation will not be responsible for crypto adoption. That needs to be a generational shift. So those two factors needs to happen for crypto to become mainstream. And the first factor, which is the one that I would say that we have more control over as an industry, which is the infrastructure. And the infrastructure evolution, the broadband phase of crypto is happening now as we speak. So it's happening in Ethereum, in the scalability solutions of Ethereum. We had like a big event last year called the Merge. Was a milestone for, I would say, the Ethereum scalability roadmap. We're having a lot of solutions that are planning to launch this year around what we call layer 2, or scaling solutions on top of Ethereum. And that kind of evolution will allow the new set of applications and a new set of adoption happening in the coming years, right? So that's why we call this the broadband phase of crypto, because we're living now, like the last 1 or 2 years, and the next 2 to 3 years, the broad-based phase of crypto. And then what will determine basically crypto adoption rate will be this generational shift. So how long it will take for this new generation that is currently playing games with digital assets, that it's interacting with digital assets as a primary facility, that generation will go to the market, and then we're going to start seeing like mainstream adoption of crypto. So I think like a big value unblocker of crypto will happen in the coming 2 to 3 years, which is related to scalability solutions.
Yeah, from David, this question is for you, and I think, and Samir, feel free to add anything as you see fit. But I think, from an investor's perspective, and specifically institutional investors' perspective, David, you've been on like crypto's buy side and the sell side as well, so you have a very good sense of kind of the types of questions and that investors are asking. And in terms of the infrastructure challenges, Samir mentioned the evolution of infrastructure. It's obviously not a smooth process, but what do you see as being kind of the big challenges that need to be overcome to kind of get to that next level beyond the broadband phase?
This is a great question. If I may just add on top and just double click on Samir's answer, which I think was great. One big difference between the bear market we're in and the previous bear markets is that now the crypto applications are a lot more tangible. So even if you go back to the last big bear market in 2018, DeFi was just a theoretical concept. Stablecoins were extremely incipient. NFTs existed only in some very, very distant corners of the crypto community. And there were and that was basically it. And then of course there was Bitcoin's investment thesis as a, I don't like to call it inflation hedge. I like to call it monetary mismanagement hedge. So that's what we had in 2018. Today, when you look at the sorts of applications that are being built around crypto, you can see DeFi with tens or sometimes even $100 billion of capital allocated, and DeFi operating a lot better than most centralized players during the crypto crash. You have NFTs as a new and firm vertical within crypto that some people think is hypish, but the underlying concept in NFTs, I think, is extremely interesting. Stablecoins are probably the biggest application in crypto right now. I think it's amazing how much this vertical has developed. And then we have a lot of new and exciting applications, which will be a lot more feasible to implement in this higher scalability world that Samir just mentioned. So you have things like decentralized social networks, and we can talk a little bit about those. You have things like decentralized physical infrastructure. So there's a lot of new applications. I mean, there's a set of established applications, and there is a set of new applications that are probably either going to work better, or we're going to see new things that we couldn't do before with crypto. So that's why I think that this new phase and this new blockchain scalability phase is important. We're seeing this, I would say, pretty much all across the space. Even in Bitcoin, there's the concept of the Lightning Network, which is a way to do faster and cheaper payments. It has been growing quite substantially, even throughout the last year in Bitcoin terms, although from a small base, but it has been growing quite a bit. And then, of course, Ethereum has become this behemoth smart contracting platform, and with all these interesting technological milestones like the merge, There's another one coming very soon called the Shanghai or Shanghai Capella upgrade. And then we're going to start to see all these very important scalability improvements coming from things like rollups or sharding, which is a new phase of the Ethereum upgrade. These things are kind of walking in parallel. They've been coming along over the last year or so. But yeah, I totally agree with Samir that we're going to see a boost in the number of transactions that the Ethereum network can handle. And this is going to be a pretty interesting trend to watch.
You mentioned decentralization, and one of the things that I think from what we learned from 2022 with the failure of so many centralized institutions, whether it's FTX or Celsius, 3AC, what have you, I think do you believe that there will be more of a kind of push and commitment towards the kind of decentralized approach to these various applications and a move away from those centralized types of entities? Or do you think we'll kind of, history will be forgotten quickly and we'll be kind of back to square one sooner rather than later?
This is a great question. And well, I can only speculate on what I think is going to happen. But if I had to guess, I would probably say that there's going to be a kind of a bifurcation. And this bifurcation will lead either into highly regulated and safe alternatives or DeFi. And when I talk about, and Samir mentioned this in his previous answer, when he was talking about the market structure, there's still a lot of room to improve the market structure that we have in crypto versus, at least compared to what we see, there's many lessons that we have seen in the traditional markets that we can apply to crypto. Some things are pretty obvious, like an exchange probably should not have a hedge fund running on the side. Other things might be less obvious, but for example, separating the activities between the exchange and the broker and the custodian, this would require tri-party agreements. It's not something that is easy to do or something that's going to happen overnight, but the industry is certainly walking and trending towards that direction. So also regulatory developments here in the US, I do expect to see one or a couple interesting regulatory developments. We can talk about regulation in more detail maybe a little later. And then on the DeFi side, I think DeFi was battle tested in a way that it hadn't been before. And I feel like, and we have seen a lot more investors becoming comfortable dealing directly with DeFi. This is not something that an investor can do yet. There's definitely a lot of risks in interacting with DeFi directly. Technical risks, regulatory uncertainty, operational risks. This is not something, this is also not a trend that will happen overnight, but we are clearly seeing some investors becoming a lot more interested in DeFi applications. I
think this this next question, I think, picks up on what you were just talking about, David, and it's for Samir. But I do also want to, we haven't talked kind of specifically about Bitcoin, and I do think it makes sense to talk a bit more about the investment case for Bitcoin, how that's evolved. Hashdex put out our 2023 crypto investment outlook last month. Obviously, the Bitcoin was a big part of that, and I think we do see the investment case strengthening. That came out before January, and so Samir, I guess my question is for you: has what we've seen at the start of this year, and given the macro conditions and backdrop, has that changed our perspective on investing in Bitcoin?
No, not at all. Actually, it kind of increased, and it goes down to reflecting on the market cycles around both crypto, but also as a macro environment and the risk assets. And we believe that we may be like in the start of what we call here a recovery phase, right? And that's, I think it's a very it strengthens the outlook and the thesis we had, like we published before January, and all those events we saw in 2022. They only, like I said before, I believe they can be a catalyzer for more adoption, as three things are very like necessary for an asset class to evolve and become mainstream I would say in the institutional investor portfolio. First is regulation. So having more clarity around how you could invest, the risks and the protections you have from the market structure. That front is going to evolve a lot. Second is education, right? So understanding the risk, understanding what can happen, and knowing how to differentiate good players from bad players. And the third one is jail time, right? So there needs to be jail time for bad actors, for fraudsters. And we've seen those three things happening in these last few weeks. So actually, I believe that all the events we saw back in 2022 with FTX, Celsius, like Three Arrows Capital, they're going to be a catalyzer for adoption, because they will improve regulation, will improve education, and will show consequences for the bad players and the fraudsters.
In terms of the Bitcoin's price, where do you see? I know there's often talk about Bitcoin trading in kind of 4-year cycles and that sort of thing. Where do you see, if that is the case, where do you see, where are we right now in terms of that cyclicality?
Oh, sure. Let me share here some interesting charts we've made in the last coming weeks, reflecting about Bitcoin market cycles, right? So remember, like Bitcoin, the main investment thesis we have for Bitcoin is like an emerging digital store of value, right? So it's the first time in our society that we can have like a digital store of wealth. And that's a new technology. That's a new asset that people need to understand. And like I said before, there needs to be infrastructure evolution, but also a generational shift, right? So we're talking about a belief system of people believing that Bitcoin can be a good store of value. And if you ask like most institutional investors and most heavy users of a store of wealth, which is like the central banks, if Bitcoin is a good store of value, the answer is no, right? So the current understanding about on I would say the main heavy users of a store of value is that Bitcoin is not a good store of value. And that's the big opportunity. So that's why we call it the emerging digital store of value, because the investment opportunity we have in Bitcoin right now is invest now. And if you believe that there will be a generational shift that will make Bitcoin being like a more consolidated, and there will be a consensus around like how Bitcoin can be a good store of value, right? So that's the big opportunity when you're talking about investment thesis for crypto or Bitcoin, outside of the speculations and pure speculations. The investment opportunity right now is betting that Bitcoin can become a digital store of value, and not an emerging digital store of value, actually like a consensus digital store of value. And like any belief system, it's very dependent on human psychology. And the cycles around like mass adoption and human biases, right? So that's why we move like in Bitcoin cycles as a pendulum between fear and greed, right? And this chart here shows like a very interesting pattern that seems to be repeating over time across different macro environments, across different adoption phases. There seems to be a consistent pattern around Bitcoin prices. And that's what we try to outline here. So you have the bull phase. Normally, the bull phase, which we call like from the last all-time high until building the next all-time high, it normally takes 12 months. So it has happened three times in history, and all those previous 3 times, it took 12 months to move from the last all-time high to the next all-time high. And then you have the bear market, which is a phase where Bitcoin goes like from the all-time high to make the new low, the cycle low, or the max drawdown for that cycle. And it normally takes 13 months, exactly 13 months. And then you go to the recovery phase, which is the time it takes from going to that max drawdown to recover the last all-time high. And historically, that has taken 22 months. So when we apply this chart here and we try to analyze where we are in terms of the cycles, the Bitcoin cycles, and we believe we are in the beginning of the recovery phase. So which is a phase where you can expect like Bitcoin to range, to have a high volatility. So there will be a price uncertainty, not too much optimism, but also not too much pessimism, a balance between fear and greed, where Bitcoin can oscillate between like a big range. And we're expecting now Bitcoin to oscillate between $20,000 and $40,000 in the coming months. And that phase, if history rhymes, which it seems that it does, it might take some 20 months, right? Until it reach the surpass the last all-time high, and then we start a new bull market, with all that price, that greed we normally see during those phases. So that's why, looking at the charts, we believe that it makes sense. There's also a big anchor to those 4-year cycles, which is the Bitcoin halving, which is when the issuance of Bitcoin is decreased by half every 4 years. And we're going to have that event happening in probably, I think it's April or May of next year. And historically, it takes some 6 months after the halving for Bitcoin to reach the previous all-time high. So it's been like a very recurrent pattern happening. And if you apply that to the current environment we're in, where the macro scenario is a little less, I would say, cloudy. And in 1 year, we might have some more clarity and a more normal macro environment, I would say, that will coincide again with Bitcoin cycles. So when you put together the recurring market cycles, the macro recovery we tend to see in the coming years, and also the scalability, the evolution of the infrastructure we're seeing in the coming months around Ethereum, but also Bitcoin, we are very bullish about this recovery phase. So we believe it's a good opportunity, if you don't have crypto yet, to start a strategic investment in crypto deployment of capital, which means like a very small amount of your portfolio, because it's a risk asset, with like a long-term horizon at hand. So looking for 3 to 5 years of investment horizon.
You mentioned that we're anticipating more normal economic conditions going forward, and that was one of the themes that we identified in our 2023 outlook. And David, you spoke a little bit about this earlier, but I do kind of want to zoom out and get your perspective on kind of what the macro environment might bring this year, and how that might impact risk assets broadly. We've talked a lot, obviously, about how it would impact crypto, but I think if you wouldn't mind sharing some perspective and kind of the macro high level, that'd be great.
Yeah, 100%, more than happy to. So as I mentioned a little bit earlier, we are in this phase in which the market is pricing a pretty immaculate soft landing being undertaken by the Fed. So far, this has been working in the sense that we are seeing inflation coming down, still not as widespread or in the speed that many would like. So of course, the Federal Reserve still has a lot of work to do, but there's definitely a feeling that we're getting towards the end of the tightening cycle, and now we're just basically fine-tuning where we're going to top and for how long we're going to stay with these more restrictive conditions. This, of course, has an impact in all risk assets, across all risk assets, that includes crypto. And I think the big question that is right now, which unfortunately I don't have the answer to, is whether we are going to see any sort of disappointment around these expectations that have been built. So they can come from many places. They can come from perhaps inflation not going down as fast as the market is pricing. It could come from the Federal Reserve either hiking a little bit more or staying at a high level for longer than what the market is thinking. And I think that perhaps the biggest source of uncertainty here is what's going to happen to economic activity once we see all this tightening, monetary tightening, going through the transmission mechanism the transmission mechanisms throughout the economy. So the big question today is there going to be a recession? Yes or no? If there's a recession, it's going to be a mild recession, it's going to be a deep recession. Is there any sort of financial accident that could come from the left field and surprises? So I wouldn't say that we are completely out of the woods on the macro side yet. But I do think that we are in a much better shape than we were a couple of months ago. The other thing I would like to highlight is that I agree with everything Samir said about Bitcoin. I'm a big fan of Bitcoin, and I think that it's a very unique asset within the crypto ecosystem. I feel like Bitcoin and Ethereum, right? If we talk about the two major assets, they've always been pretty different in my view, but I think that over time they are becoming more and more different. So Bitcoin has this immutability qualities and features that allows it to be this digital gold, this sound money type of asset, while Ethereum is much more focused on features and programmability and developing these decentralized applications that we talked about. On the Bitcoin case more specifically, I think another interesting thing is that we are seeing a little bit of the Bitcoin macro thesis play out, in the sense that this is not something that is going to become evident or that I would expect the market to price in the short term. But if you look from a longer term perspective, we are seeing some pretty frenetic changes on monetary policy, right? We're just coming from record flexible financial conditions to probably a record fast tightening. So the monetary policy is changing very quickly. There's also the geopolitical issues, and there are these analysts talking about a potential Bretton Woods 3 or new monetary type of system. So I just want to highlight that over the long term, there are some pretty important changes happening at the very core of our monetary system, and that Bitcoin could have a big role to play in the future. Again, these are not trends that develop over weeks or months. They're probably more like over years and maybe many years. But I want to highlight that the case against which Bitcoin is supposed to protect, I think, is kind of in its early innings, but in my view, clearly developing. So I do like Bitcoin. I think it's an interesting asset to have in a crypto portfolio, and it's substantially different from pretty much the rest of the crypto ecosystem, which is more of a technology play and focus on features, programmability, and applications, and that sort of stuff.
We've got a bunch of questions, and I promise I'll make sure and save enough time at the end to get to those. But I did just kind of want to close with one final question here before we get to the Q&A, just around regulation. I think both you mentioned it earlier, and maybe if both of you want to kind of share your thoughts on how, the FTX situation is obviously going to drive a lot more regulatory and legislative activity. And I think in 2023, if you all could share your perspectives on, specifically how regulation may impact the broader ecosystem, crypto ecosystem, but also investors, like things investors should be thinking about as they're, reading the headlines about regulatory actions and legislative proposals and that type of thing. So I don't know, David, if you want to start with that, and then maybe Samir, add your perspective as well.
Sure, I can start perhaps quickly talk about the US. I think, well, regulation has always been a front and center topic, and increasingly so. And I do think that in 2023, it will probably be even more so. Just as the stakes are getting higher, the industry is becoming more relevant. And on the regulatory side here in the US, I think we see two interesting factors kind of potentially playing against each other. The first one is that there is much more awareness across regulators and lawmakers about crypto, to the point that there is a fair number of lawmakers that are very pro-crypto and that understand this industry extremely deeply. So it is impressive to see how much progress the industry has made with DC basically over the last 18 to 24 months. And this is something that we are very clearly seeing. I do think that there's probably 2 or 3 top topics that I think regulators are probably mostly focusing on. Number one is stablecoins. I think this is the least controversial one. I would expect to see some sort of stablecoin regulation happening in the US, maybe in 2023. I think this would be an important unlock for crypto because stablecoins is an important vertical in the industry. The others are a little bit more contentious. So you have the security status dispute between SEC and CFTC. What is a security? What is not? There's the Ripple lawsuit that might be decided in the middle of the year. So this one's a little bit more uncertain and probably something related to market structure that I think we're still in the early innings of discussing. The other thing I want to mention is that it is also very important to think about regulation in the context of the political setup that we are. And one thing that a lot of our investors are paying attention, rightfully so, in my view, is that we are now operating with a divided chamber, right? So we have a Republican House and we have a Democratic Senate. And not making any political statements here, but the current politicians that basically are in charge of the House of the Financial Service Committees and the Senate Banking Committee. So this is where quite a bit of the crypto legislation could come from. They have basically pretty opposing views. On one end, we have like the best industry champions you can think of. On the other hand, you have some big industry detractors. So I think that the challenge on regulation for the year is because of this political division, we might get into a little bit of a gridlock and not see a lot of legislation actually happening in the year. That's why I mentioned stablecoins. I think this one is very uncontroversial or relatively uncontroversial, but the rest I think will depend a little bit on these 2 parties being able to talk and find an agreement.
Yeah, no, I think David said it all. I think there's basically 3 types of regulation. So first is stable coins. The second is market intermediaries, right? So exchanges, custodians, and all those intermediaries that type of regulation has become very pressing and urgent after FTX and all the events we saw last year. And the third one, which is more complicated, is how to regulate decentralized finance, right? So how can you regulate smart contracts that don't have necessarily an owner, don't have a controller, and they are just like self-executed on a blockchain. So that's also a very tricky challenge that the regulators will see in the coming years. As for the regulations of market intermediaries, we've seen that happening all across the globe. I would say like probably the US is late on that, which is sad because it's the largest capital market in the world, and it was supposed to be leading that movement, and it's also lagging, right? So we've seen like a good regulation coming out in Europe. Here in Brazil, we're seeing like a strong push from the regulators, both like the Congress, the central bank, and the securities regulator here into regulating the market intermediaries and giving more clarity for institutional investors. That has been like a great movement here. But the US is lagging on market, I would say market structure regulation. And on the stablecoin side, I think it's very promising what's happening. So stablecoin has been one of the, I would say, biggest success in terms of use case for crypto recently. And we expect that regulation to be a catalyzer for growth as well. We need some kinds of protection to investors when you're talking about the stablecoin, which is, you can argue that it's basically like a money market fund that the shares can be traded, right? So that type of regulation on stable coin, it's more complicated also because it depends a lot on the government's view of CBDCs, right? So how the central bank digital currency interacts with the blockchain, with crypto, and with stable coins. So it's more like it can determine it can have geopolitical consequences.
That's so one of the questions we received was about central bank digital currencies and kind of the impact of these proposals on crypto assets. And so Samir, I don't know if you have anything to add on kind of your overall view and CBDCs and what it means.
Would love to hear David's take on that as well. But my opinion is that, remember, I was talking about the generational shift. And when you have CBDCs, either on blockchains or south blockchains, you're actually having the concept of digital assets that will be part of the day-to-day life of the population of that country, right? So that can be a catalyzer for adoption and for usability of digital assets, and crypto may benefit from that. So even like the concept of having a digital wallet, and that you have like a central bank issued currency on that wallet that you can make payments globally, like the cost of incorporating digital assets, of crypto digital assets into that digital wallet is marginal, right? So I think it can be a catalyzer for crypto adoption as a whole. And even like you can even talk about like how the CBDCs can benefit from the blockchain technology, right? So some discussions, some central banks are considering issuing CBDCs as stable coins on top of an open blockchain infrastructure. So that can be also very promising for smart contract platforms like Ethereum.
Yeah, no, I agree 100% with Samir. I do think that CBDCs, when they come, will be a big normalization factor for the general public to get used to dealing with wallets and private keys and all that sort of infrastructure and setup that you kind of need in order to onboard into crypto a little bit more seamlessly. And then just to drill a little bit on a point that Samir raised, I do think that CBDCs and crypto, they are actually pretty different. I don't think that they compete directly. So especially when we're talking about public blockchains like Bitcoin, for example, these technologies are a lot more about non-sovereign and fixed monetary base. They are a lot about providing a little bit more user privacy, while on the other hand, CBDCs, I think that the factors that they enable, they are much more linked to discretionary control over the monetary base or even surveillance mechanisms. I think it will depend a lot on the country. Some countries are okay with these type of policies, others are less. I do know that in the US, there's a lot of discussions around that. Federal Reserve seems to be a little bit, they've been studying CBDCs for a long time, but they seem to be a little bit reticent about some of that implications. And as Samir just mentioned, maybe the solution is just to do a stablecoin, which could be potentially a much more market-friendly or private market-friendly type of solution to provide a digital US dollar. So that's what I think about CBDCs. I don't think that they compete with crypto. And I agree that in the long term, there will probably be a big normalization factor for folks to start dealing with crypto setups and infrastructure.
It's great insights. I think this next question is probably one for both of you as well, but it's around institutional interest. In particular, has there been a spike in interest as prices have improved this year? And will that lead to lower volatility over the long term? So kind of a two-part question there. I don't know, David, if you want to go ahead and start.
Yeah, I can definitely start. I think that institutional interest has definitely arrived in 2020, and I don't think it has slowed down significantly since 2020, since the FTX issue. The thing is that these allocators, they tend to underwrite much longer investment theses, and they have due diligence and investment committee processes that are much longer than what a typical retail investor would do. So usually their decisions have they take longer to happen. I don't think that these decisions have stopped. I don't think that institutional investors stopped looking at the space, but they're definitely maybe not as in a rush as they were 6 or maybe 9 or 12 months ago. I think that we can see, well, there's a few indicators that kind of point to that. The first one is that FalconX has been seeing record numbers of institutional onboarding clients, onboarding of institutional clients. It's something that I think speaks a little bit to this institutional interest in the space. And you can also look into some indicators from certain venues that tend to be institutional only or heavily institutional tilted. So you can look at, for example, open interest in the Bitcoin futures and ETH futures contracts in the CME. And these numbers have been actually quite strong. Actually, the CME market share in the futures market is the highest it has been in a year. So I feel like these things are indications that the institutional players are still in the space, even if their decision processes have been have lengthened a little bit.
Yeah, no, same thing here. I think like the interest is still here. We still have a lot of conversations. I think there's a big difference this time when comparing to other cycles. Remember talking with institutional investors back in 2018 or even March 2020, and the main question was, is crypto over after this 80% drop? Now it's like, now crypto is over, and so that the whole argument in the bear market of those different cycles were around like if that investment thesis has ended. And now what the main question we're getting is this the bottom, right? Is this the, you know, the start of the recovery cycle? So crypto adoption by those types of investors is not anymore a matter of if, it's a matter of when. So the narrative has changed. They're trying to understand. We still have blockers, and they're mainly related to the generational shift again, which is understanding the investment thesis. It even, like, I think the most frequent question we get from institutional investors is around the valuation framework, right? So how can I evaluate what is the value? How can I calculate the value of a network like Bitcoin, like Ether, which is like a very complicated question that we're going to find out as the asset class evolves, right? So I don't think that we've seen like a change in interest of like people really trying to understand what is happening and if we are starting a recovery phase. And the second question he made was around the decrease of volatility, if that could lead to a decrease in volatility. I don't think necessarily like the institutional adoption necessarily would decrease volatility, but I think that regulation and a more stable and secure market infrastructure under a regulatory framework that can collaborate to decreasing the volatility, because we will improve the price formation process. Like, remember, crypto trades 24/7 in a very fragmented market. So there's no trading limits, there's no auctions, there's no methods of really like trying to converge to a fair price. So if evolution in the market infrastructure can help on that front. And also time, like as the investment thesis matures, the volatility will decrease. And this is the same thing again that happened with the internet or the internet companies back in the 90s. The volatility was huge, and then like as the years came, as they showed their value and started getting real usage, the volatility decreased. That same thing happened also with computer companies back in the 80s and the 90s. So it's part of the technological aspect of crypto, part of the evolution of the investment thesis. We expect the volatility to decrease as solutions get more mature and as we see more usage of crypto.
It sounds like a perfect place to stop, and I apologize for those that had questions we didn't get a chance to address today. You can certainly visit hashdex.com or falconx.io if you want to get in touch with us about any additional questions. But David, Samir, thank you guys very much for this conversation, and more to come. Thanks, everyone.
Thank you all.
Take care.
Bye.